Were gold prices hurt this Wednesday by the forecast cut made by Goldman Sachs and a technical glitch releases FOMC minutes a tad earlier? All this next. Morning, Jim. Let's start off with those FOMC minutes that were released earlier than expected, showing a divide among officials. Let's talk about how that's affecting gold prices.
Good morning, Daniela. And well, the FOMC minutes, indeed, there was a glitch. They apparently got emailed out to a few firms early, so they were released early this morning. However, that the FOMC comments and the news was not really significant. No major developments in the marketplace. The gold market sold off just a little bit as the U.S. dollar strengthened a bit. But the bottom line is the Fed members are a bit divided on whether or how long to continue with their quantitative easing. But they are in agreement that the quantitative easing it's got its negatives, but it's been more beneficial than it has negative.
Jim, did it show that there's still deep divisions among officials about how long the bond buying program should continue? In your opinion, could QE even end now?
No, I don't think the aggressive monetary stance on the easing side of the Fed is going to end anytime soon. They may signal at some point in the coming weeks or a few months that that it may end in 2014 or 2015, but I don't see it ending anytime soon, and here's why. The Bank of Japan last week embarked upon or reiterated their very aggressive monetary easing. The European Central Bank has recently given indications that it may further ease its monetary policy. And then last week's jobs report that was much weaker than expected reiterates the fact that the U.S. economic recovery is still tepid. We could see further economic weakness, and that all augurs for the Fed to keep its foot on the easing accelerator for monetary policy.
First Soc Gen, Jim, now Goldman Sachs revising its gold average forecast for 2013 down to 1545 from a prior forecast of 1610. Do you pay much attention to this?
Well, Daniela, I don't read a whole lot into forecasts from these firms, and I'm not meaning to pick on Goldman Sachs, but it seems like if the price of gold goes up a certain amount, then these guys adjust their forecast. And if the price of gold goes down a little bit, they adjust their forecast down. So what I'm trying to say is these firms most of them are behind the curve on the price of gold movement, and most of them tend to be off the mark most of the time. So I don't read a whole lot into that.
But Jim, do you think investors are paying attention?
I think some investors might on a short-term basis, but here again, 2 weeks or 3 weeks from now, if the gold price has moved significantly from where it's at now, they're going to revise those numbers again. History shows that. So I think the important thing, and I talked about this in my Kitco reports, the longer-term price trend in gold remains up as evidenced by the monthly chart. We've certainly had a downside correction recently, and it's been significant. But the past 12 or 13 years, we've had downside corrections that are similar, only to see gold rebound and move to higher highs. Now, the important line in the sand for gold market long-term investors remains the $1,500 level. That's not only a technical support level, but also a psychological support level. If we see multiple daily closes in nearby COMEX gold futures below $1,500, that will then start to produce longer-term chart damage that will then call into question the longer-term uptrend that remains in place at present.
But if we go down to 1,500, Jim, doesn't seem so far away right now. Is there that much of a risk?
Well, like I said, Daniela, if we can challenge that $1,500 level and then move off of that to the upside, then I think the day has been saved for the bulls. But like I said, you get prices closing below $1,500, that starts to produce longer-term chart damage to then change the overall longer-term technical posture from bullish to neutral. Once again, if you look at that monthly chart, there's an uptrend, a longer-term uptrend line remains in place from the 2001 low of $255 an ounce.
Jim, offline, I know we were talking about North Korea, and it's yet an issue to impact gold prices, but you think that might change?
Yeah, the marketplace at present is paying attention to the North Korea situation. I would say the marketplace has not reacted significantly, but that could change. And let me give you an example. Yesterday, we had U.S. government officials say that the North Korea crisis that is in place right now is the most serious geopolitical crisis that has occurred in many years. And for them to say that, the U.S. is taking this very seriously. The U.S. has deployed military assets to the region. This situation could deteriorate very quickly, and I think then you would see some safe haven demand quickly show up in the gold market.
So, Jim, are you not in agreement with George Soros, who recently said that gold is no longer acting as a safe haven?
No, I would disagree with that. History shows that the gold market can tend to act lazily and kind of ignore developments like North Korea recently. But when the going gets really, really tough and investors get really, really worried, that's when you see them start to move into gold.
Jim, finally, let's pull up your Wyckoff market rating system for the week. Let's look at the grades you're giving for gold and silver.
For June gold, we see solid overhead resistance at the $1,600 level. We see solid support at last week's low of $1,539.40. And I'm giving gold right now a Wyckoff's market rating of 3. That's near-term bearish, no doubt about it. Silver, for May silver, we see solid overhead resistance at $28.50. We see solid chart support at last week's low of $26.57.5, and I'm giving silver a rating of 3 also. So the bears in the precious metals, the gold and silver market, do have the near-term technical advantage.
Jim, thanks so much for being with me. We'll see you next week.
Can't wait till next time, Daniela.
And thanks for watching this edition of Technically Speaking. You can email me any comments or questions at newsfeedback@kitco.com or follow this conversation at Daniela Cambone. Thanks for watching.